Hello everyone and welcome to today's webinar hosted by Credit to Be. Today we have Richard Hastings of Global Hunter Securities taking the pulse, the economic signals at Q2 of 2014. What we're going to do is if anyone has any questions during the presentation, you can type them into the questions function and we will ask the questions at a couple of times during the presentation. So with that said, I'm going to pass it over to Richard Hastings to start the presentation.
Justin, thanks very much, and hello to the guys in the room over in Newark, New Jersey. And Ken, let me know, first of all, can you hear me okay? How's the audio sound?
Very good.
Great, and welcome to everybody else on the telephone. It's great to be with everybody. So let's get into our material. And let's make sure that the screen is moving along. We should see a little disclaimer screen. Is that the case, Ken?
Yes, it is.
Very good. So that part of it is good. And generally speaking, the summary of conditions in the second quarter is that things are getting better. More people are working. There is a problem of less wealth creation. The pressure is building up from all sides of the political spectrum to consider pushing minimum wages higher. Some areas of the United States are already taking action. I would say that the evidence is beginning to build up that unless the United States does this, that top-line growth across multiple sectors, bleeding from one major sector eventually into another, will diminish too much, and then that creates way too much pressure on management to manage margins, EBITDA, and earnings per share in the SEC-registered companies. And there's already evidence that some of this is happening as mergers and acquisition activity is percolating higher, and management is starting to look at asset rationalization as ways to improve EBITDA trends, as sales growth trends are starting to get more difficult to push higher. And that's because wealth creation in the United States is becoming more difficult. Even though the economy has gotten better, the middle class numerically is not growing. It is contracting. In some of our other studies that we've gone through in the other webinars, we've seen evidence of that. We're not going to go through that today. But because we've already seen the quantitative evidence that that is the case, we now have enough evidence to suggest that wealth creation is becoming a bigger theme, and it'll definitely become a wonderful political thing for everyone to play with when we get to the presidential bids for 2016. If Mitt Romney is comfortable talking about raising the minimum wage, and Romney's not going to run for president, and I don't think at this point, based on Hillary Clinton's health profile, she may not run for president either, even though if she were healthier, I think that she would probably make a bid. She may be playing around with it, but I do think there's a question mark out there about her health. But minimum wage pressure is building up. There's a good article in the Wall Street Journal, I believe it was, or Bloomberg News this morning, that more and more sources, including the CEO at Robert Half International, noting that wages have been drifting higher. That's a good source. And then, of course, there's more evidence from it from some of the data that I've looked at. Wages have to go up in the United States. If they don't, we're going to see more trouble. Let's take a look at the first part of the story. We're going to spend some time in the beginning of our Q2 update looking at labor statistics. And let's take a look at some of the data for jobless rates based on age tiers. So for everybody 16 years and higher, the unadjusted, and I typically only work from not seasonally adjusted data, unadjusted data, and let's take a look at where are we in April 2014 for the jobless rate. Comes in at 5.9% for everyone 16 years old and higher, compared to 7.1% 1 year ago. That's an improvement of looking at it this way, it's lower by about 17%. That's a good thing. And that compares very favorably to the jobless rate 5 years ago when it was 8.6%. And we're still above where we were in April of 2008 when it was 4.8%. But as we start to go into these age tiers, people who are 25 to 34 years old, people who are 30 to 34 years old, people who are 35 to 44 years old, and then those who are 50 to 54 years old, what we've seen is very, very logical in the context of some other studies we've done over the last few months looking at labor participation rates among those who are really more mature workers, those who are about 35, 44 years old and older. And what we're seeing is that those labor participation rates are better for more mature workers, including those who are more than 50 years old. And as we go through the jobless rates over here, they start to get better as you go into the more mature pools of workers. So there's more pressure, more tension, less easy wealth creation among younger workers, especially in those critical family building, household building years when people are about 25 to 35 years old. And that's where there's more trouble in the United States, and that's where the wage pressure starts to become a part of the story. Because as we all know, home equity credit in the housing market is no longer a source of credit and capital to the middle class like it used to be for years going into 2007. Since that time, when I look at home equity debt that is outstanding, in the latest quarterly numbers from the Fed, the amount of home equity debt that's outstanding has drifted all the way back down to the levels where it was when the housing market peaked out in price in the fourth quarter of 2006. It's just not a source of credit and capital. That puts the pressure on the wage part of the story. Inflation, not in the 1970s definition of inflation, but inflation is slowly reawakening, and more stories are starting to point to that. It's a major theme in my strategic view of the stock market and the entire intermarket system. So it's going to be a big factor. You have agricultural output problems from the vast drought in the western United States. Now you have a new drought building up once again out of Texas and Oklahoma, emanating up into Kansas. And if that spreads and persists in the Corn Belt and in these big agricultural producing states, Missouri, Arkansas, Iowa, Illinois, creeping potentially into Indiana, but we're not there yet. We have to see how it goes. But if that's the case, then you have the case for higher costs of food concurrent to persistently high costs of two other forms of energy, which is retail gasoline prices. They're not going to go down. And then, of course, natural gas, which is being used more frequently as a major source of energy in the electric power sector, and then directly for the residential and commercial buildings. Those prices, they've come down a little bit recently, but they won't go down a lot. And it's very likely that later this year, natural gas prices will go back up all over again. Moving on to the next slide. Way too many little numbers on this page. So Ken, you guys will make sure that you share the PDF version. But let's just look at a few highlights of the big components of the labor story in April 2014. We're on slide number 5. April 2014, total non-farm numbers of employees, people who are working, unadjusted, not seasonally adjusted, 138.3 million. That's a 1.75% growth rate on a year-over-year basis, and just slightly higher than where we were 5 years ago. Not a bad thing. But let's take a look at the civilian labor force at 154.8 million people. That has barely grown on a year-over-year basis. It's a little bit higher based on population growth. It's about 1.1% higher than it was 5 years ago. That is a little bit troublesome. What we want to see is a better relationship over time between the total number of people who are out there and eligible to be in the labor force and those who are employed. Numbers of people who are employed across all different aspects of employment, whether it's full-time salaried employment or only marginally employed, comes out at about 145.8 million people, a growth rate of 1.4% on a year-over-year basis, and essentially flat against where it was 5 years ago. We are seeing in the unadjusted data that the job story has grown by about 2.3 million people on a year-over-year basis. Again, the numbers that we run are unadjusted. The headline numbers that the media will work from are seasonally adjusted numbers that are based on a concoction of two different surveys, the household survey and then the establishment or the business survey, and then the Bureau of Labor Statistics has to mathematically come up with some sort of a number, and people will then start to repeat the headline numbers, and the media will regurgitate it saying that the U.S. added 225,000 jobs in the month of April on a month-over-month basis. When you dig into the real numbers that are the components from which they build this stuff, those headline numbers literally don't even exist. Once you go back in to the mathematical foundations of this stuff, those headline numbers are truly a bunch of statistical nonsense. It's just not the real story. The real story is that job growth on a year-over-year basis has been much greater, but within that, about 48% of the way jobs are being created is coming from lower wage types of things, and quite a bit of that is coming through temporary staffing agencies and outsourcing services. Huge volumes of jobs being created through administrative and office cleaning types of things, different kinds of retail, medical office, and other kinds of medical and health services. Many of these jobs are coming through temporary staffing assignments that are putting people to work for more than 35 hours a week. When that happens, they're considered employed full-time, and that goes into the full-time bucket, and mathematically the Bureau of Labor Statistics will say that those people are working and those become payroll types of jobs. So we got about half of the job story is coming from a lower wage part of the system, and it's creating pressure on the entire economy to boost those wages. Visually on slide number 6, you can see a little bit of what this looks like. We are getting broadening, slow growth. That's a good thing. It's a little bit slower than the rates that we saw back in the late 1990s, which was a good period. And then the more erratic but even faster growth rates that frequently were seen in the decades prior thereto. I'm going to stop right here, Justin, as well, and see if there are any questions so far. You guys on the phone, send in your questions by the chat in your software. Ken and Justin will see them, and there's no reason to wait until the end. You can ask questions along the way. Ken, we got any questions so far?
One question.
Yeah.
The drop in the unemployment rate,
Yeah.
I know more jobs are being created, but less people are looking. Is that possibly because the baby boomers are starting to retire in greater numbers, so there's just less people in the workforce looking for jobs? What's your thinking?
There's a few different things. Statistically, there's a little bit of a pressure coming from the 55-plus part of the pool. There's some early retirement stuff going on there, and there's some other ways that those people, 55-plus, are employing themselves. That's a little bit of it. The other piece of it is this enormous amount of funneling through the outsourcing and temporary staffing part of the job system. I would not give too much weight to the idea that the jobless rate is getting better because eligible people are exiting the workforce. It's a little bit the opposite, that actually people are finding work, but the wages for many people is a huge problem. And it's a problem for the entire economy. It really is an issue. I would not have said that a year to a year and a half ago. Ken, you've been listening to me say this stuff, you know, what is it, like 6 years? This is probably the first time you've really heard me say this, and it has really gotten to the threshold where now it's time to change the relationship of wages to the entire productive cycle. If we don't do it, then we will have new problems, not like 2007, 2008, but more classical economic subnormal growth with other types of problems that then lead to subnormal levels of labor utilization. That's a long answer for a simple question, but hey, that's what I'm here for.
Okay.
Moving right along, slide number 7, we're looking at the same idea on a percentage change basis, and you can see that nowadays we're getting growth, annualizing it at like about 1.7, 1.8% year over year. That compares not as well to what we saw in the 1990s. Again, what you were saying, Ken, about population, ages, younger baby boomers. Some of the boomers are, they're really getting up there. You got baby boomers who are like 60 years old, stuff like that. That's a bit of a problem. Then you get these spikes, when you go back decades earlier, the economy is much more erratic, but when it did well, it did much better for these brief periods of time, but much more erratic. I would say that the evidence now is pointing to a lot of learned behavior among central bankers and policymakers globally. And I do see evidence that the planet is learning how to avoid major breakdowns in the system. A lot of what happened in 2007, 2008 originated out of severe malfunctions in how the banking system overexposed itself to the housing market. Other aspects of the banking system were healthy, but it made an enormous error betting way too much on the housing market. You can't expose yourself too much to the consumer sector unless you're doing, let's say, retailing. That is a much simpler business. But if you overexpose yourself to the behavior of people, look out. People are not that rational, and they will do things that really don't make long-term sense. Anyway, going to slide number 8, let's take a look at metropolitan areas in the United States. And these are the 20 largest metros in the U.S. These are the 20 biggest, and we're going to look at their jobless rates, looking at the unadjusted jobless rates in March. Unadjusted jobless rates in any place will vary enormously between December and January because so many people wind up finding more than 35 hours of work during December in different kinds of temporary types of gigs. When that happens, they get counted as full-time, and then in January when their seasonal work comes to an end, the jobless rates start to go back up. So what you do is you just compare January to January and December to December and see what the trend looks like, and then it starts to make seasonal sense. Month-over-month calculations are dangerous on that basis. You guys see it in your business. I mean, especially if you're doing something like a supermarket type of concept and you're looking at the kinds of merchandising that is done for a major holiday event, say Memorial Day, Independence Day, July 4th, Labor Day. Those things can move things around enormously. Then the merchandising is entirely different. The price points are entirely different. So you got to be careful about the month-over-month stuff. Looking at the metro areas, Minneapolis, St. Paul is the best at 4.9%. Washington, D.C., 5%. And these are moderate improvements on a year-over-year basis against March 2013. As we come down to the bottom, it gets more interesting to look at the bad stuff. So the inland California manufacturing area, Riverside, San Bernardino, that vast metro area over there, you can see that the jobless rate was much higher in March of 2013, and it's still high at 9.4% in March of 2014. Chicago, this is connected to the problems in Chicago. Labor utilization there is very problematic. I am seeing evidence of problems throughout the Midwest. The Midwest across the board is got all kinds of issues. Some of them have their origins in demographic problems and population losses that have been building up for about 20 years. But I do see problems in many metros in the vast areas of the Midwest. Chicago is a part of that story. 8.1% is a pretty high unemployment rate. Compares a little bit better year over year, but it's still high. LA, of course, is complex. It's a vast area with its own set of problems. There's been improvements in some office construction, some manufacturing, but there are vast areas of underemployment in that metro. St. Louis, problematic. New York has deteriorated for about 2 years now and is not what it used to be in the broadest definition of the New York metro area. Stronger places that have been doing better. I think that we're seeing some improvements in Phoenix. Miami is greatly improved, the Miami metro area. And then the Houston vast metro area with pretty stable demand for labor associated with the enormous energy industry there and all the different services that support it. That's a pretty strong area down there, and people can drive for long distances back and forth. So the whole vast megalopolis down there in Houston, Port Arthur, going down from Houston to the coastal areas, there's a lot of employment opportunities in the area. Job growth on slide number 9. The Pew Charitable Trust is saying that the best job growth in 2014 is going to come from North Dakota, obviously all energy related, not a bad thing. Arizona, very nice. Texas, Colorado, Florida, Georgia, South Carolina, no surprise there. And then Oregon, Idaho, and Utah. The weakest trends among states will be coming from Washington, D.C., mostly because they've already maxed out how much can be done there. Illinois, for reasons that we saw before, tax environment is lousy. A lot of different issues in the entire state. The state, from a budget perspective, cannot really do anything. A lot of problems. South Carolina, by comparison, the government there will always do something to invite businesses in. Illinois is running out of any way to create sufficient incentives to bring companies in. Weak growth in much of New England, except usually for New Hampshire, is usually a little bit better, more of a tax-friendly environment. The other ones, usually Vermont and Maine, are more disappointing. And that's a little bit of the story over there. Let's go to slide number 10 to begin taking a look at surveys of about 6,000 shoppers a month to get a sense of the state of the mind of the U.S. consumer and the household sector at April 2014. The index for confident, very confident attitudes about a strong economy, anything above that median line there going straight across the middle is a good thing. We very successfully came back from the latest government shutdown fears in 2013, and the trend has been good. The number is not as high as it used to be. There's a lot of people who are not convinced the U.S. economy can be a strong economy, and the wage and problem and the lack of wealth creation are very much a part of that explanation. Looking at the two-axis chart, numbers on the left-hand side, numbers on the right-hand side, the dark blue line, those percentages go to the left side. The light blue line goes to the percentages on the right side. Those who have little confidence in prospects for a strong economy, it's usually a bigger number, and that's been trending a little bit below about 44. We've been running at about 44, 43%. That is actually a good thing. Anything below about 45% is good. Those who have a more confident attitude, those who are very confident about prospects for a strong economy, that number has been much better but erratic, trending between about 7% and 10%, but it's becoming more erratic and more responsive to different kinds of little hints of problems. So the winter was a problem. Winter energy costs were a problem. and that's a lingering issue in retail sales. We'll see evidence of that in a minute. But I would say that when you look at surveys, and I think I have the explanation for the surveys, yeah, right there. That's a really cool table we're going to look at. You'll see that most people who respond to any kind of a survey, consumer household type of survey, usually they're not too busy. So we'll see an explanation of that in a minute. Moving right along, slide number 13, those who say they're going to be shopping for sales more often, big improvement, very, very good. So people, because they're working, even though their wealth creation is lagging, they have enough spending power from having wages that they're not as obsessed about looking for sales incentives. So the pressure for price incentives is not as severe as it was in the big picture of things. Depending on your business, whoever you are on the other end of the phone, you may find yourself, your product, much more exposed to those who still have to look for price incentives and for lower initial markups. And then there's other kinds of products that are, you know, more higher priced initial markups that hold on to full price longer. And in those cases, this chart would probably come at an even lower number, maybe 20 to 25% would be the response level. Going to slide number 14, another good slide showing us that the reaction of people to higher gasoline prices, they've gotten used to it. It is a drag on wealth creation, and those who say they're going to be driving less has come down below and stayed below that very important 40% level, and it is now below 35%. That's a good indication. But the problem psychologically behind that is that even though people are saying that they're not reacting as much to the gasoline price volatility the way they used to, they still have problems finding a sufficient amount of wealth to spend a lot more money. Psychologically, the reaction to gasoline price volatility is better, but the real spending power is not what it used to be, especially prior to 2007. Now, this on slide number 15, 15 and 16, I'm going to explain this. So there's a question that you pose to the consumer asking them, are you going to be putting off spending on the following categories over the next 30 months? It's called deferrals. Are you going to defer spending on this category, this category, this category of spending over the next 30 days? I think I said 30 months, 30 days. So what you do is we know that people are spending like crazy on electronics and connectivity. So with that being the case, and we know that this stuff costs a fortune, the service contracts, not the phones. I'm telling you the truth now. As a Costco member, and I don't think you have to be a Costco member, Costco Wireless, I got a Galaxy 4 Mini, and it ain't small. The thing is a pretty big smartphone. Galaxy 4 Mini with a new 2-year contract through Costco Wireless, and it cost, I did a new 2-year contract, and the phone itself cost, are you ready? 1 cent. But the service contract's expensive. So what you're looking at here on slide number 15 is the relationship between people deferring spending on apparel, in the big picture, apparel and accessories, and deferring spending on electronics. As that line goes up, 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 up to the right, that means that they're deferring spending on clothing and not as much on electronics and services to, you know, be connected. That is not a good thing, and that partly explains why sales growth rates in apparel, accessories, footwear in the big picture, especially in the moderately priced market, has been suppressed now for quite a while. Even worse, it's been pretty bad in the dining out sector, but there's a little surprise over there on the right-hand side, and for whatever reason, we're seeing a little bit of a rebound in this chart where the people are saying that they're not deferring on eating out as much as they did before. Maybe it's because they're finding jobs. Maybe it's because they can find places to eat that are affordable, but whatever it is, this is definitely a good indicator that people are working and they're interested in going out to eat. And when I say dining out, that's the definition in the survey. It does not mean that they're going to, Ruth's Chris or Ken Frisco's. It just means that they're finding someplace affordable to go out to eat. So that's a little bit connected to that improvement in being employed and having wages. The bigger picture, of course, goes back to what I've been complaining about, and it's wealth creation. Now, look at this when you talk about people who respond to surveys. In this case, this is who responds to surveys. And this is not only in this case. So this one is a juicy one because it's like 6,000 people and more. A lot of these other surveys, like the University of Michigan survey that comes out on Fridays every month, that's 500 people. That ain't good. It's not enough people. If you were to go to the management at Walmart and say, hey, I want to talk to you about this telephone survey we did of 500 people, I mean, I don't know how polite they would have to be to wait for you to finish saying, the rest of the sentence. Those who were employed full-time who responded to these surveys, 41%. Retired, 21%. Unemployed, 15.5%. Working only part-time, almost 15%. You get the picture? People who know somebody who's been laid off, well, that could be the case anywhere. Somebody who's disabled, probably maybe it's Social Security disability, and they're only getting that check. That's not an easy way to live. It's a lot of financial constraints, 6.2%. They know somebody in the family who's been laid off, pressure right there in the household, and they're concerned themselves with being laid off, 2.7%. But it's when you really start to pile up the retired, unemployed, part-time, those three numbers right there. Let me get my, let me get out my great big calculator over here, the one that's got the big numbers because I'm getting old, and add these up, 14.8. That's 50.1%. So those three right there is much more than the participation in the survey from those who were working full-time. Because it comes out at 50.9% compared to 40.9%. And I do win a Nobel Prize for doing that math, by the way. I'll let you know. Ken will send you an email. Questions, Ken and Justin, any questions coming in?
None here.
Okay. Now, the retail sales, as we all know, retailers don't really publish monthly sales anymore. Few of them do. They're worthless statistically to do anything with. So that gives you only one way of doing monthly retail sales analysis, and that's from the Census Bureau. It's not that bad in certain ways of looking at it. Looking at unadjusted data only, this morning the data came out, did not give us enough time to update these slides for April preliminary data. However, there were revisions to their retail sales data going back to the beginning of 2011. And from some of those, I had a little bit of time to start running those revisions. And this is what we come up with. April X automobiles, meaning taking automobile sales out of the picture and just looking at merchandise and food service sales, supermarkets, dining out, and merchandise. April retail sales growth on that basis grew year over year at a 2.38% rate. That is good because it went above 2.5%, which is my threshold for where the number needs to be. It should not stay below that number for long, but it's been below that number for a while, not only because of the winter disruptions, but the winter energy costs and what it does to the mood of the consumer and how much wealth they really have to draw upon. March ex-auto retail sales, unadjusted year over year, grew at 1%. 1.00%. February grew at 1.37%. January grew at 2.35%. That's before the severity of the energy bills really kicked in. And December, which is supposed to be a much stronger month, but year over year, looking at it, comparing it to itself 1 year earlier, grew at only 2.44%. Again, staying significantly below the 2.5% threshold for quite a period of time. There's better news coming from lawn and garden, home improvement, building materials. That category showed growth of 2.7% in April and 4.5% in March on a year-over-year basis, not seasonally adjusted. Those are good numbers, and that partly speaks to the very strong survey results that we see from the National Association of Home Builders regarding remodeling. People are doing things to fix up the houses that they have because they're worth more, so they're allocating their spending resources more towards taking care of their houses and fixing them up, thinking that they're worth more money, and now they are worth more money. Of course, there's only one problem. You sell yours, where are you going to move? Anyway, in the meantime, people are starting to spend money on fixing up their houses. That's a good thing, but it changes the merchandise mix away from moderate market merchandise from goods to more durable goods. And when you start to see the home improvement store numbers like this start to percolate higher, some of that is connected to contractors and the cost of services to have somebody do this for you. If you're working full-time, a lot of hours, like some of us, you're not going to have time to do all that stuff yourself. So the long-term story of retail sales in the United States has drifted lower, and it is a troublesome trend. The revisions don't really help. They're still weak on a year-over-year basis. April's a little better at 2.4%, but we're still below the 2.5%. If we're starting to see that home improvement, building materials, lawn, garden is getting better growth, then there's part of the explanation. Let's go to slide number 20 and looking at our methodology to see if we are indeed growing from where sales were when things crashed. I run this metric every single month, and the evidence from that suggests a flattening out in the growth story against November of 2008. That's when sales began to contract on an absolute basis, again using unadjusted data. And then we started to finally grow after 28 months of contraction, and we started to grow again against November of 2008. The evidence now shows that we're flattening out, more difficult to get growth. Some of the other source of spending where the household sector is reallocating its resources is towards automobiles, partly because what else are you going to do? You always have to look good, and you want to feel good, and having an automobile is a way for people to do that. What are you going to do? Nothing wrong with that. And automobile sales have been quite favorable, trending higher, usually at about, I would say averaging 8 to 10% year-over-year growth. Part of the reason why they do it is that all the newer automobiles have much higher fuel efficiency, and then that knocks down the cost of gasoline at the pump. So the nominal cost of gasoline at the pump might say $3.95 per gallon. If your fuel efficiency is higher, then that nominal cost at the pump gets adjusted by your fuel efficiency. Newer vehicles are so much more fuel efficient, and that's part of the reason why they do it. It makes economic sense, and you get to look pretty too. The chart of building materials home improvement is better. I will run the revisions, but based on the latest revisions for at least April and March, the numbers are healthy, and I would expect that with house price appreciation being what it is, it's been so strong, those numbers are probably going to hold up. So that's a good thing. Employs a lot of people, and those wage rates are pretty good also. Electricians, plumbers, it's expensive stuff. Look a little further. We're on slide number 23. Questions, anybody? Anything coming through? Justin, Ken, anybody with any questions at this time?
Yeah, we actually have a couple questions.
Oh, great. That's good.
Let's see. We have one that says, do you think that the continued manipulation of economies around the world on a rotating basis for the purposes of propping everyone up can be sustained, or are we just building up for a complete collapse across all westernized economies?
I do not believe in that theory. I do not believe that we're building up towards a collapse. The idea that central banks and policymakers are manipulating things, it's pretty much all they do. It's pretty much all that we do as people. We try to avoid staying at the precipice. We try to avoid looking down. So when we do that, we're just not going to pay attention to how or why we're not staring down into the abyss. We just want to stay away from it. But as time has gone by and different kinds of crises are learned by central bankers and policymakers, more is learned about how to avoid doing the next big mistake. That gives you time for the next big mistake to build up. So when we look back over, let's say, the last 25, 30 years of global financial patterns, we find a classical recession and bear market in stocks between late 2000 and really early 2003. Long bear market, big long recession, but all of it very classical in nature. Then you get a totally different kind of beast in 2007 that had to do with something that people were too young to really remember, that they should have understood would have been a stupid idea, and anybody who was around in the 1920s would have told them, don't do it. But people were too young, and then the other ones started dying off, so the memory of it faded away, and everyone started to do the banking system, the home equity credit thing, and the whole thing blew up, similar to a little bit of what happened in the early 1930s. So that one was something that can have happened when memories fail. But I do not believe in the collapse idea. I do not believe in a new, bigger doomsday financial scenario. And I don't believe that the manipulation is so unusually new that that they've invented some sort of a new way of manipulating people. People are very limited. They're going to sit there on their smartphone and desperately wait for feedback to whatever they're twittering and entering into Facebook or anything else that they're doing. People are desperate to be seen. Turn on a movie from the late 1920s, early 1930s, and look at most of the way people were acting in the movies back then. The behavior is the same. The costumes look a little bit different. The skin exposure is a little bit different. But basically, the urge towards getting attention, the search for comfort, to avoid suffering, to be free from suffering, those instincts are the same then, and they're the same now. And if people have to manipulate each other to get there, they'll do it. In that sense, I would refer back to thousands of years of human history, and some of it has not changed. Next question.
Sure. What do you think about the Japanization of America based on an ever-aging population that requires larger and larger government obligation payments, adding to an ever-growing deficit?
The United States has an enormous problem with poverty. In Japan, the population story is much more severely tilted towards an aging population. We do have some of those features here, but what we have different than Japan, we have a much more diverse population, ethnically very diverse, and there are many different parts of the United States ethnically that have very healthy population growth rates, unlike Germany, some other European countries, and Japan, where population growth is an absolute negative. Over here, the poverty is the other source of absolutely enormous government involvement. Some of it might be excessive, but I would warn, as I always do, that if you start pulling the plug on all this stuff, you're going to feel it yourself, and it's going to be bad for everybody. The poverty in this country is severe. So you have a little bit of the aging population, but nothing like what we see in Japan, which is unusually bad, and some of the other European countries. It's actually much, much better here. The population growth outlook here is pretty good, but the poverty here is enormous. And that is a big issue. What do you start pulling back on in terms of programs? What programs can you reduce without having massive repercussions? It's a delicate situation, and I will warn any fiscal conservative who thinks that all those plugs should be pulled. You'll die too. Your 401k will die. The repercussions financially would be catastrophic. So if we don't want to have any kind of system to contain the severity of poverty, the repercussions would be catastrophic. That's how bad it is. Wage growth would help, and selectively changing the way some of the programs are executed would also help. Improving some of the decriminalization would help. And some of that's already starting to take place. The bottom line with the United States, way too much poverty, and it's expanding. It's getting worse. So if this country doesn't do something about that and figure out how to fix it in a new way, then you'll have new troubles and you'll have subnormal economic growth, and eventually it will impact the stock market too. Let's go back to slide number 23. Looking at the responses of survey respondents on slide number 24 about the housing market, their attitude about buying a house over the next 6 months has flattened out. Number one reason why? Anybody can figure this one out. If your house price keeps going up, then whatever house you're going to buy is going to cost up. So as the entire market system has become more expensive, the cost of moving out of what you've got into something else, it's going up all over the place. That's the reason that survey looks that way. Looking at the story for those who are 55 and older, now that is a much better market. We've got someone whose line is not muted, just in case. I do hear a little noise, just in case. Slide number 25, where you do see health in expansion in the housing market is actually on the commercial side, and it's the index of sales expectations for the building of 55-plus single-family attached homes and multifamily condo attached types of homes in bigger communities. That is a strong market, both fed by growth in the number of people who are 55-plus, some of the early retirement stuff that we heard about earlier when Ken and I exchanged that question. But that is where probably you see the biggest strength in the construction market for the household sector. Looking at the wealth story based on average income, for those who are in the bottom 90%, that doesn't mean, down there at the bottom. It just means that for 90% of those who are making income, the average of that comes out right now is trending towards about $31,000 a year based on households. That's bad, and that's pulling from the severe poverty at the lower income tiers in the household sector. Once you start to go into the household sector and you start to look at households that have annual income of $30,000 a year, $25,000 a year, $35,000 a year, it is a massive number of households. It's a bad situation. Now, some of that, of course, can get adjusted by different kinds of subsidies and programs that have an indirect benefit to some of those households for various reasons, but they're really not a good source of wealth creation, and I would not describe the lifestyle of being in one of those households as being fun. It doesn't sound good. But what you do see over here is the evidence that the middle class was growing in its average income for a long period of time, for decades. Then it starts to flatten out in the 1980s, goes up a little bit in the Clinton 1990s, and has been coming back down. That's a problem. And that's what I'm talking about, and that's what people are complaining about. That number has to stabilize, otherwise it puts more and more pressure, and then the way people will vote, they will vote for much more socialist forms of government to force it to change, and that's already starting to happen. Looking at the other side of the coin, for those who can participate in the housing market and into the stock market, ever since the crash in 2008, the correlation between net worth and the stock market, using the S&P 500 as our proxy for the stock market, is enormously correlated at about 97.3%. So for those who are able to participate in wealth creation through the stock market, through bond funds, through equity funds, through different kinds of ways of investing into securities, in addition to their paper gains for their real estate holdings and capital gains from their real estate transactions, wealth creation has been enormous, and the stock market has been feeding off of that very nicely. That gets more difficult to do, and the evidence from the S&P 500 on a sales per share basis suggests that that is getting harder to do. Looking at slide number 28, new homes that are actually sold, not seasonally adjusted, not annualized, it's not what it used to be. Ideally, it should be above 40,000 units a month, and the demand for new homes is still subdued as wealth creation remains difficult and house price appreciation starts to run away from real wealth creation for the middle class. The demand for new homes should start to lag and weaken. The Federal Reserve, Janet Yellen, has already noted this explicitly in her latest Federal Reserve FOMC commentaries to the different committees of the Congress and the Senate. So it's already starting to become a policy issue that the housing market is slowing down. In reference back to what we said earlier about home improvement building materials demand, the demand to remodel your house, however, has gone up, up, up. That's a little bit wobbly in a couple of areas in the West and in the Northeast, two areas that are already excessively expensive. Again, you get to a point where it's like, all right, I'm going to fix this place up, and then what do I do? And then what do I do with it? My house has already gone up in price, and there's no place for me to move. A little bit more mobility in the Southeast than in the South, generally speaking, including places like Texas, Louisiana, which are expanding a little bit better. Louisiana, also a more tax-friendly kind of state. Let's finish up by taking a look at sentiment and business confidence indicators from a bunch of other countries to get a better feel for where things are in the second quarter. So I will end the part of the conversation about the United States by saying that wealth creation in the U.S. is a big problem. Sales per share growth rates in the S&P 500 have been disappointing and are becoming a problem for the stock market, despite what the stock market looks like over the last few weeks. But it is being noted as an issue. But when you start to go around the planet, the outlook for stability has improved a lot. China is different than it used to be in the big picture of things, but China is so large, like the United States, that a decelerated growth rate for China doesn't necessarily mean that China is contracting. It's just really, really decelerating, and the contribution of real estate in China is something that will continue to deteriorate going forward unless they want to have a bigger problem, and they might. And that's probably the only single issue, putting aside a massive outbreak of, military disaster in Ukraine, Russia, but I don't think that would happen. But the other big macro risk factor to the planet would be China real estate banking. That remains to be seen. I have a funny feeling that they are going to work their way around it. Remember, it's not a very transparent cross-border kind of environment, they can kind of do what they want. It's not as easy to do something like that in the United States. Euro area consumer confidence going through March of 2014, going way back into the beginning of 1989, we see a very nice rebound in consumer confidence over there. Consumer attitude in Europe has been rebounding as things have continued to stabilize. Remember that places like Portugal has exited being a bailout country, and they're not seeking any special bridge loans to stay out of that. Greece is actually able to go into the bond market and issue debt. So, you know, the last major blow-up in Greece when the whole thing erupted into an absolute disaster was really in late 2009, early 2010. Before you and I turn around, it's going to be the beginning of 2015. It's more than 5 years ago. You give things enough time, and you know, they start to get better. So countries over there, Spain, for example, things start to stabilize. They may not get a lot better, but all the consumer has to feel is that things have stabilized and their mood goes up quite a bit. In the UK, things are rebounding over there very nicely. Manufacturing, financial services, London's connectivity to the Orient and being a massive hub for so many different services has helped the consumer attitude over there. UK consumer confidence rebounding very nicely. Looking at Germany, looking at a survey of economic expectations among businesses, we see that things were getting better and better. And the latest data on Germany, export market activity, not very impressive. Germany still very exposed to weakness in a lot of Europe countries. That's a problem over there. And I think it gets more difficult to get a bigger, longer rally in Germany's business sentiment than would otherwise be the case. They're just overly exposed to the kind of budgetary constraints that are taking place in so many of their export partners in the EU. Moving over to South America, you have countries like Colombia, which is a big oil producer. Colombia, very interestingly, has a problem with indigenous peoples and with rebels who like to, you know, throw little grenades at their oil and gas pipelines. And then the indigenous peoples would like for the government to basically stay out of their land and not go in there and even do anything with oil pipelines. And then the rebels will go in and they'll attack the pipelines where the indigenous peoples live, and then you can't even go in there and repair and do any work on it because they're not going to let you in, and you don't want to get them more angry because then all it does is creates a more fertile environment for the rebels. Notwithstanding, Colombia has rebounded very nicely, and Colombia is actually a pretty strong oil-producing nation with a strong export economy in energy and a few other commodities, typical of other countries in South America. It's a fascinating story. Colombia, very interesting. Mexico, seeing a little deceleration in some of the exports of capital goods, which we've seen going up for the last 4 years. Mexico's production of capital goods does put some pressure back on China. You might remember the last time we did one of these, I talked quite a bit about China and warned about, the slowdown over there. Over in Mexico, there has been a good rebound in consumer confidence until recently, and it looks like they're going through another one of their slumps, which is kind of typical of Mexico. The key is over in China, there's a deceleration in the growth rate in retail sales. The retail sales volume is enormous. The place is just so gigantic. March retail sales in China in dollars, $326 billion. So, the economy there is absolutely colossal. Put aside the concern of the manufacturing sector over there, the China consumer wants to spend money, and it is a fertile area to explore selling your products to the retail market over there. That part of it is holding up, but it is decelerating if there are bigger problems in China's banking system relative to real estate, then we could see an even greater deceleration in retail sales. But that has not yet happened. The government over there will do anything to prevent it from breaking down. They don't like doing that. Consumer confidence has become very erratic over in China. Recently it's been rebounding, and I would say that it's probably going to be erratic for quite some time to come. Now, we're going to conclude with the China observation and take our final questions. And I'll summarize the state of the rest of the planet at the second quarter going into the summer. Things have stabilized globally quite a bit. The volatility of the Japanese yen against the euro and against the dollar has improved notably. There's pressure over in Europe to weaken the euro a little bit. There are ways to do that without changing interest rates at the ECB. There's coordination between the Federal Reserve, the Bank of Japan, and the long it decreases. It makes it more difficult for management to generate more EBITDA. You do have a little bit of pricing power. Outright deflation where prices in the aggregate are contracting, it's a bad thing. But it can be improved. So we've noted that going into the summer, the two big risk factors in the planet, there really are two outside of the United States wealth problem, which is not a volatile thing. The volatility comes from Ukraine-Russia conflict. I think the way it plays out is that the Ukraine very quietly disintegrates in its eastern provinces and goes into a little bit of a civil mess, and Russia may later on quietly absorb some of those pieces. They can kind of let it take care of itself. It's a problem for Ukraine's bailout with the IMF. That remains to be seen what kind of an impact that might have on global bond markets. China, banking, real estate, the government is doing, I think, decent efforts to suppress further speculation in real estate over there. Real estate is excessively expensive, really worse than over here. A lot of countries in Asia, real estate is a horror. Other countries are a disaster for real estate affordability. Back to the United States going into the summer, risk factor for economic growth and for long-term stock market gains. The problem starts to reflect back on wealth creation and the diminishing wealth story of the middle class in the United States. But those are not big volatile problems that can blow up. Those are long-term structural problems that will have political consequences, very likely to be seen starting in early 2016 when the election furor starts to really ramp up. I'm going to end my comments right there and send it back to Ken and Justin, and if there's more questions, we can answer them right now.
Yeah, we had a couple more questions come in for you, Rich. So we have a question that says, it seems that a vast majority of the wage improvements are coming from record government benefits along with record disability payments. How does that affect your overall view of wage growth?
I would want the person to send me their statistical sources proving that that is the case, and what is the change in those levels of how do we explain that wage growth is primarily being created by government sources and not from companies paying people any more money per hour. I would like to see more statistical sources on that. So I'm going to defer. I don't think that that's the case structurally, so I can't answer the question in any simple form. Let's go to the next question.
Sure. In the last few years, private equity has been one of the largest buyers of home, aiding in the increase of prices in the housing market. This has contributed to record levels of rent across the country, further pushing housing costs out of reach for individuals. What do you see as the long-term effects of this?
Yeah, that's an excellent question, and that is a huge problem. So in the earlier part of the recovery for real estate, obviously you've got pools of participation from those who have the liquidity to do so and to mitigate and hedge the risks of being exposed to it, something that, smaller participants can't do. So as that starts to ramp up and their participation in real estate starts to increase and increase and increase, it will create its own problem, which is now coming home, and that is, okay, because of all the stuff that's happened from the institutional involvement in the housing market, now the value of my house goes up, and so it goes up for anything else that I want to buy, unless I want to move to, let's say, a quiet county in North Dakota. I could do that. I like cold weather. I could do that. I mean, it's not bad for you. But, it's its own, self-destructive kind of thing where all they're doing is seeding, they're basically creating the groundwork for a slowdown in the whole thing. And we see that already in the residential housing market story. It's already starting to slow down. Their involvement in it just create this. Now, this is not a bubble. That would be very wrong for us to say that. But it's one of the tightest markets for housing in the last 30 years. It's way too tight. The turnover has been way too fast, partly because of the institutional participation and the number of people who can afford things based on the loan structures. It's not a pretty story, and that's why the Federal Reserve is explicitly making these comments that they're looking at this and they're like, you know what, there's something in there that we don't like. Now, they can talk it down through a lot more mentioning of it, and then they might be able to do something through how loans are formed to the residential market, and they're starting to talk about that at the policy level in the last couple of days as well. I think it's a great question. Some of the answer has already been created out there because it's its own monstrosity. But then there's the next question of how do policymakers really slow down the institutional participation so that house price appreciation decelerates down to more realistic levels. What's happening in the residential market is bad. You're getting price increases year over year, 8, 9, 10, 11%. That is a disaster. The rent equivalents are awful. So back in the really bad days, going into rental was a good idea, or back in the days like in 2005, 6, and 7, at the peak of the entire market, going from ownership to rental was a great idea because rental was so affordable because the rent market was so bad. Now the whole thing is lifted up, and there's value nowhere to be found unless you go to, really way out there rural areas. And for a few people, they can do that. This has to decelerate, and it will either decelerate on its own. I don't think there's any severe repercussions to the system from that happening. This is not a big banking system vulnerability here. This is not a bubble. This is not going to fall apart. It's nothing on that scale, but it's self-destructive, and I think people are feeling frustration on this front as well. For a while, you're going to see the effects that consumer confidence is bolstered by the feeling that your house is worth more money, and that nearby comparable house sales are occurring at prices that make you feel better. It's real simple. It's like stock options working for a company. you know, in the end, it's only worth the cash that you're going to get when you sell the stock options that you exercised, bought the stuff in the open market, but then that's only paper. If you want cash out of that, you got to sell it. It's the same thing. So it's you know, self-destructive, and the numbers are ridiculous. It's really unaffordability is really going to start to become an issue to a greater degree than it already is. And I'll stop right there.
Okay. That's all the questions that I have. Ken, do you have any?
No, none in the room. We're fine.
All right. Well, then I'll stop and thank all of you and turn it back to Ken and Justin. And thanks. Questions, send them to Ken, Justin, or to me directly. And look forward to the next time. Thanks, guys.
Thank you, everybody. Thanks for attending.
Thanks, Richard.